our first segment, as you might expect, is about the U.S. It's about the big news. There's a lot of big news, of course, but one of the big stories that came out this week is middle of the week. We had the Fed Chairman Powell came out, talked about banks, talked about deposits. He had a speech. The Federal Reserve raised the rates 0.25%. At the same time, Janet Yellen decided to give a speech and confused the markets and people as well. So, Patrick, I know you were watching this in real time. What were your thoughts as you saw this unfold this week? And are our deposits safe?
No, our deposits are not safe. Let's start with the first question, right? Because that one is such an easy one. Nothing is safe in the dollar. That's how I feel. You guys know that. So,
What?
what I thought about his remarks was just like, it was just like absolute shittery, right? What was he saying? Let's talk about this. So he's saying, no, the banks, everything is safe in the banks, but we're only going to bail out the big banks, is what Yellen is saying on the other hand. But then they're asking Yellen, hey, well, so are you going to just only bail out the big banks? And she said, well, we're going to see if they meet our criteria. What's the criteria? If they're a big bank. Why? Because the money just goes back from one place to another, back from one place to another, and a 1/4 point hike. I mean, they just threw in $300 billion. Like, it appeared overnight, and then it got spread out, and they're not even putting them into the banks. The banks themselves don't even want to invest the money in us. They're putting it into like really low yield interest bearing stuff. I mean, man, I'm so hot about Powell, and I don't like Yellen, and I think she is just a huge liar. How could any of this stuff not impact the United States? How could it not impact the entire average, everyday, working American citizen? I don't care who you are gonna feel the sting of this. Holy moly. These guys
Yeah,
are just criminals.
well, I'll get to that. I'll voice my opinion on some of those things as we go. But Dylan, let's get your take on what's happened here as you were catching up after a few days off this week.
Yeah, I mean, so many times have we've seen in the past, especially few years, when some prominent figure that's been the talk of social circles comes out and says something. It oftentimes means the opposite, right? We've heard it in safe and effective. We've heard all these things. And so when he comes out and says your deposits are safe, that means people are worrying. That means people are giving him an agenda saying you need to address this. You need to quell the fears of the population. And with some of the largest bank collapses in history happening in just the past weeks and those being kind of swept under the rug like no big deal, like it's reasonable for individuals to be concerned and to not take what Jerome Powell says at face value, right? Because what does it even mean that your deposits are safe? Like, what is the implication of that? So, you might be able to get access to your money at some point in time, but how much purchasing power will you have after you can get access to that? That's a huge issue. And we're here all talking about things that you can self-custody. If you look at our logo, we got the Bitcoin, we got gold, we got silver, and we even have some axes on there for being able to be self-sovereign and be able to self-custody your own stuff and not trusting a third party. And that's a huge problem. I think people really who haven't thought about it, the counterparty risk involving a third party in assets that you own or need or want to get access to is extreme. And we know about it because we deal with Bitcoin and crypto stuff, but the average person doesn't. They don't realize the risk that they're taking, especially right now with all that's going on in the world.
And I would even take a step back. Like if I were to say, okay, Patrick, do you think that your deposits are safe? I might even say yes. Let's just say yes to that real quick. If the answer is yes, our deposits are safe, it's because they can print as much money as they want and put it in the account. So therefore your money is again safe. It has nothing to do with the fact that they are good stewards of your money. It has to do with the fact that, oh, we could just make more of them. Just print off another trillion, send them to the big banks. You're good. You're covered. Don't worry. It's all safe. All your deposits are safe.
Yeah.
There's so much we can go into this. And first off, I will correct for our audience, just so you know, now we all know this. We interchange money and currency a lot. We see that a lot. But they're printing currency, not money. And people are going to learn real soon that silver and gold and Bitcoin are money, the tangible or intangible assets. but currency is, especially fiat currency, all dies eventually. So, and you can't make more money. You can't just produce more silver, gold, or Bitcoin unless you go by the rules or dig it out of the ground. But the currency, you can just make it out of thin air. But going back to Yellen and Powell, which was amazing that they were both talking at the same time. And I've seen many press conferences from both of them. They often don't tell you anything. Everybody tries to watch these things, read between the lines, see the direction that they're going. But these two people are really PR arms for the United States. And that's just saying, like, okay, everything's fine, nothing to see here. It's kind of like, Naked Gun. It's like, nothing's here, please disperse, we're all fine. Well, everything's burning right behind them, right? They are trying to calm the markets. The mere fact that they have to talk about, is your currency, are your dollars safe? The mere fact that question even comes up means that people are asking that question. So they are concerned because they're saying, what about FDIC? Is FDIC legit or not? And there's been many videos, and I've been talking about this a while. It's so grossly underfunded. The insurance is about 1.5% funded where it should be.
Doesn't matter. They're just going to print more money. Who cares?
It
doesn't need to be funded at all.
But then you get to start talking, and we will talk about how this ties into crypto and the particular banks that went under. We talked about that in previous episodes as well, and how that's sort of a pseudo conspiracy theory, but most people have caught on that most of the banks been targeted lately do have a crypto angle. But also this is an angle to launch the CBDC that they're trying to accelerate. And that's certainly going to be continuing a topic. And we could, as blockchain people and crypto people, that we understand this, we know the differences between blockchain and Bitcoin and CBDCs. They are not one and the same. They're very different. CBDCs and Bitcoin are nothing alike. And people have to understand.
They're going to make the best version. I'm sure the Fed, they know better. They're from the government and they're here to help.
Of course. Thank you, Ronald Reagan. Appreciate that quote. But this is a perfect opportunity and angle for them to launch CBDCs and say, hey, we understand that we only have $2 for every $100 that are in the bank, but we'll supplant that and give you 98 CBDC dollars to make you whole.
Yeah.
And now they've injected 98% of what they wanted to inject in there in the first place, and see if they can get that into circulation and get the velocity money going again, because that's also been struggling in limiting the economy, because people aren't spending because they don't have the money, they don't have the currency to spend. So there's so many different angles you could talk about that, and we could talk on that one topic probably forever. But another topic that's coming up about the U.S. economy is they're trying to control inflation in many different angles. So they raise the rates a little bit, just like the UK did. We'll talk about world events soon, but they're also talking about labor and unemployment, and they're trying to drive unemployment up because they figure out a correlation between unemployment and inflation. And the higher the unemployment, the lower the inflation. So they're going to try to drive a lot of unemployment now, but we're getting all these stories like Walmart layoffs. We have another one from Disney with layoffs, and we've heard from Amazon. And these aren't just like 500 people. This is 7,000 people from Disney. Yep. We've got Walmart was, I don't even know what this number was, but it was a large number in here. Maybe you guys could tell me because I can't remember what it was, but it was big.
I think it was like 12,000.
Yeah, but also if you look in this story, at the very bottom of it, right from Zero Hedge, there's a great graph that shows you this area in red at the bottom here. The cost of living has outpaced wage growth for Americans, which means that their buying power, their purchasing power is going down, even if they hold a job. So they're making, for 2 years. So, I mean, there's lots of comment. Dylan, please lead us off and make some sense out of all this if you can.
Oh man, it sounds like a classic case of optimizing for the wrong variable to get the solution that you want, right? Like I don't know. There's probably some quippy saying out there that encapsulates that. But when you said that they found a correlation between inflation and unemployment, and that the higher the unemployment, the lower the inflation, and inflation's been a big thorn in their side for the past couple of years, and then wanting to reduce it, and so they decided to do that by reducing the number of people employed. Like that just sounds like a terrible thing, because what's going to happen to those people? I mean, at least as an individual that cares about people, that's terrible. But maybe as the government, you're like, wait, we can just increase the number of people that don't have jobs, and at the same time increase the number of people that are now dependent on us for their livelihoods, and we can also make the economy look better by decreasing inflation by doing that. Right? That's just recipe for disaster. It just seems like a system making a fatal mistake.
Seems like the whole thing is a recipe for disaster. But Patrick, what's your take on some of this stuff?
I just don't trust any of the numbers they're telling us ever. Even when it comes to unemployment, they revise their unemployment numbers so our unemployment numbers aren't even accurate. We've seen that happen a lot. I mean, if you look at how they reverse the numbers, we went back like 5 months, not only in unemployment, but let's also take a look at other numbers that they're not telling us the truth about. 5 months ago, they started trying to reduce the amount of assets that were held on the U.S. balance sheet. And so we were down to like we're down now where we came back to, because they printed all this money, is like 5 months worth of work from them trying to correct the balance sheet and work on inflation by increasing interest rates and reducing the number of jobs available. But yet here we are 5 or 6 months later, no better and a whole hell of a lot worse, waiting for something even worse coming because the numbers haven't caught up yet.
Yeah, and they can paint a picture in a lot of different ways, and a lot of it goes back to real estate. And we're going to look at a video in a moment here from Jack for Nobody Special. But we're like, even the real estate, one of the last bastions of wealth, of having wealth available to us, those prices are coming down, and commercial real estate is getting impacted. So there's a lot to talk about just that. So Patrick, if you could share that video.
Real quick, I just want to comment.
Go ahead, Dylan.
Just on the unemployment numbers and these layoffs, you've seen the meme out there where it's a joke on the minimum wage per hour, and then it shows McDonald's opening their first like fully automated restaurant. So you basically using machines and AI to run the restaurant, right? Because they can automate away jobs at this point in time, and that's going to happen faster and faster and faster. I know we've talked about ChatGPT and these various forms of AI and the growth of that sector. And what that does is that just streamlines a business process. I just heard a TikTok video, this guy talking about consultants and Microsoft launching their AI program for Microsoft Word, to where you can have it record your calls, take meeting minutes for that call, create action items, and create an output to share. So it's like, hey, create a 10-slide deck encapsulating the meeting and the client's goals and where the client's at and where we need to take them. And the AI can do that in just minutes. So what would take a whole team of consultants or a manager and a couple of analysts can now be distilled down to a conversation between the client and one person. And if you scale that out, and that's a complicated job like consulting, where you have to have insight and you have to have some experience in structuring things. But if you apply that to just task-based jobs, where it's step 1, step 2, step 3, step 4, right? And you look at the combination of the Boston Dynamics robots and AI, like jobs are going to disappear so fast. And that's a whole new thing to contend with. So I just want to point that out when we talk about job loss, that's coming.
Yeah. So here's the video. Patrick, go ahead and hit play for Jack's video here.
All right, let's talk about Blackstone. We had this one came out just yesterday. This is Joan Solotar. She's the head of private wealth solutions at Blackstone. She was giving this interview with Bloomberg yesterday, and there was a whole lot of blah, 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 blah about liquidity in there. She was really doing a lot of CYing of her A. But it's this comment that she made that commercial office real estate in the U.S., specifically office, is much worse than people think. All right, now that's important because I want to just give you a quick review of a couple of things Blackstone has been in the press about lately. All right, check out this one. Blackstone stops making payments on a $325 million Las Vegas office loan. That was a 1.5 million square foot office building. Blackstone just walked away. We're not paying for it anymore. That was on March 21st. We also had Blackstone defaulting on this Nordic mortgage-backed bond. That was on March 3rd. And that was a 531 million euro bond that Blackstone defaulted on. So they're just walking away from their loans right now, just defaulting on them. Things are not going very well at Blackstone. Oh, and what about this one? Blackstone's B-REIT. This is hilarious, by the way. B-REIT, that's Blackstone Real Estate Investment Trust. It's the biggest commercial real estate investment trust in the country. All right. They've got tens of billions of dollars of commercial real estate. Now, they released this note a couple of days ago, and this is hilarious, that their B-REIT records their biggest advance in 6 months. Blackstone's Real Estate Investment Trust, the Blackstone Inc. Fund for affluent individual investors, reported its biggest monthly return in 6 months in February as dividend payments and rising rents offset a decline
Do you hear that? Biggest ever. But just keep listening.
in property valuations. Now, the reason this is truly hilarious, and it shows you just how disgustingly biased the financial press is, what they're not mentioning in this article is this headline that BREIT has limited withdrawals from the fund for 4 consecutive months. All right, so I just take this in context. They're walking away from mortgages all over the country. They're talking about how they had their best month in 6 months, and the dividends and the payments offset slightly declining valuations. Well, it's easy to maintain higher valuations when you don't allow your investors to withdraw their money for months.
So,
Thanks, Patrick.
Dylan, I would like you to comment on that little clip there because I know you and Jack hit it off pretty well. So I figured he would like to see you respond to that one.
Man, it sounds like they're propping up the value of their own fund by restricting cash and capital outflows from their system. It sounds similar to what happens in other places that are struggling. They reduce the amount of capital going out in order to keep the things that they're invested in still looking good, so they can get their ducks in a row before it all comes crashing down.
Yeah, kind of
That's
reminds me of
Before what?
Before things turn ugly.
Yeah,
Before,
I mean,
have you seen the South Park meme where it's like, yeah, and then you deposit your money here and it's gone.
Yes.
So
Wait, what?
and it's gone.
I mean, this is the weird stuff that how are we not paying attention to this stuff? This is so important and it's happening all around us. And understand what he said. They're defaulting on euro bonds as well. What is that going to do to the value of the euro?
Yeah, and I'm sharing this. This is another story from Blackstone a couple of weeks ago about how they're REIT and they're limiting withdrawals, and also this story like Zero Hedge, like they started doing premium and they started hiding some things, but the title says it all. Nowhere to hide in CMBS, which is commercial mortgage-backed securities. If you've seen The Big Short, if you've seen Too Big to Fail, we are on the brink of that again, and that was 15 years ago in March. When it started, but it took 6 months to really play out because Bear Stearns was bought in March of 2008 on a fire sale, and then it was waited till October for everything else to collapse, and we lost Lehman Brothers. So and other banks merged, but I think that it's gotten way worse, and there's way more currency in circulation now, which means there's way more derivatives and way more financial instruments that are out there in this financial system that's just waiting to implode. So just to wrap up this section here, I think we should take a look at the DXY before we turn the page over to the world events, which has got plenty of other things going on. But Patrick, as I pull up the DXY, you want to walk us through some of that?